Ladies and good day, and welcome to Embassy Office Parks REIT's earnings conference call for quarter ended 30 June 2021. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ritwik Bhattacharjee, Head of Capital Markets and Investor Relations at Embassy Office Parks REIT. Thank you, and over to you, sir.
Thank you, Stephen. Good evening, everyone, and welcome to the first quarter FY22 earnings call for Embassy REIT. Embassy REIT released its financial results for the quarter ended June 30th, 2021, a short while back. As is our standard practice, we have placed our quarterly financial statements, our earnings presentation discussing our performance, and a supplemental financial and operating data book on our website at embassyofficeparks.com under the Investors section. As always, we would like to inform you that management may make certain comments on this call that one could deem forward-looking statements. Please be advised that the REIT's actual results may differ from these statements. Embassy REIT does not guarantee these statements or results and is not obligated to update them at any time. Specifically, the financial guidance and any pro forma information that we will provide on this call are management estimates that are based on certain assumptions, and they have not been subjected to any audit, review, or examination procedures. You are called to place undue reliance on such guidance and information, and we cannot assure you that we will be able to achieve the results. Further, there are significant risks and uncertainties related to the scope, the severity, and the duration of the COVID pandemic, and the direct and indirect economic effects of the pandemic and containment measures on Embassy REIT and on our occupiers. In a significant move, the trading lot size for Embassy REIT units on the Indian stock exchanges will be reduced to 1 unit from the current trading lot size of 200 units upon the notification of the necessary amendment regulations. The announcement follows the Securities and Exchange Board of India's approval of the amendments to the appropriate regulations to reduce trading lots for both REITs and infrastructure trusts or InvITs that it outlined at its board meeting on June 29, 2021. The reduction in lot size brings the trading lots in line with those of listed equity companies on the Indian stock exchanges, and it helps in increasing liquidity, enabling REITs to be included in potential benchmark domestic indices, and allows for greater participation from newer pools of institutional and retail investors. Joining me today are Mike Holland, the CEO, Vikash Khdloya, the Deputy CEO and COO, and Arvind Maya, the CFO. Mike will start off with the business overview and strategy, followed by Vikash and Arvind. We will then open the floor to questions. Over to you, Mike.
Thank you, Ritik. Good evening, and thank you for joining us today to review our Q1 FY22 results. Despite the full-year pandemic, Embassy REIT delivered in FY21. The second wave and lockdown, which started in April 2021, brought similar challenges, but we have had the benefit of prior experience and, of course, the ongoing vaccine rollout. COVID cases and deaths in our 4 cities have been in a steady decline since early May and are now at a fraction of second wave peak. The last few weeks have seen a steady relaxation of restrictions, reopening of businesses, and uptick in economic activity. While companies are operating with minimal staff levels, our discussions with occupiers indicate plans to return to office in strength starting fourth quarter of this year. Embassy REIT remains resilient and delivered on its guidance last year. This quarter is no different. As we cautiously enter the recovery phase, we emerge with strength and growing momentum, and this is reflected in the encouraging operating results for this quarter. We signed new leases and renewals totaling 545,000 square feet during the quarter at 13% leasing spreads. We are in line with the expiry and renewal numbers we reported last quarter. Our occupancy stands stable at 89%, and our rent collections remain robust at over 99%. Our active development pipeline will deliver 1.1 million square feet this year, which is fully pre-committed to JP Morgan, and we have an additional delivery pipeline of 4.6 million square feet over the next 2 to 3 years. We are developing our acquisition pipeline, supported by our robust balance sheet, and we are making good progress with our ESG initiatives. Over 10,000 frontline staff across our office parks have been vaccinated, and in addition, we understand from our occupiers that over 110,000 vaccinations have been completed for their employees and families. Our perspective on the business outlook and our strategy has not changed. If anything, our previously articulated views have been reinforced. We cater primarily to global technology companies and global captive centers who are in India for the STEM talent that is required by these global businesses. We continue to see strong growth in tech and allied sectors, with many of our occupiers reporting record hiring and new business wins. Given our continuing investments in park infrastructure and our new build program, combined with our ESG and employee wellness initiatives, we are confident that this global tech megatrend will convert to strong demand for our product, the total business ecosystem. Embassy REIT is well positioned for new growth given our concentration to the right markets, and we will benefit from consolidation of supply and acceleration of demand. An update on a few changes within our team. We have reinforced our leasing team through the appointment of Amit Shetty as co-head of leasing for South India, alongside Rishad Pandole, who remains responsible for our North and West portfolio. Amit Shetty has 15 years of leasing experience in the Bangalore and South India market and has been appointed to focus and accelerate our leasing activity in this 170 million square foot office market. Additionally, earlier this year, Sachin Shah, our CIO, had expressed his desire to step down to pursue other interests. We are grateful to Sachin for his contributions, and we wish him great success with his future endeavors. Ritik Bhattacharjee, who has been responsible for our capital markets and investor relations function over the past 2 years and is known to many of you, has been appointed as CIO with effect from 1st August. Ritik has over 12 years experience in investment banking and capital markets. We have also appointed Rahul Parekh to lead our debt raise initiative. Rahul has over 15 years experience in the public debt markets. Our management team now stands at over 120 individuals with expertise across the full property business cycle and continues to be fully focused on delivering to our unit holders. Let me hand over to Vikash to provide an update on our business and operating performance for the last quarter.
Thanks, Mike. Good evening, everyone. Business and operating highlights for Q1 include total lease up of 545,000 square feet across 9 deals, achieving 13% leasing spread. We maintained stable occupancy of 89% with successful rent increases of 13% on 2.2 million square feet leases. Our construction on 5.7 million square feet development projects continue, with 1.1 million square feet JP Morgan campus targeted for handover by year end, and we have progressed our ESG strategy and continued our investments in park infrastructure and amenities. Let's look at the details. First, an update on our operations during the second wave. COVID-related restrictions by state governments were in place across our 4 cities through most of Q1. This disrupted back-to-office efforts of our occupiers, with less than 5% of workforce operating from our properties during the quarter, a significant decline compared to Q4 of FY21. However, all our properties were fully operational to support business continuity of our occupiers. On a positive note, recent data suggests a steady increase in recoveries with active cases now significantly below the second wave peak. Vaccine rollout has also been gaining momentum. Corporates today are focused on vaccinating their employees, providing a safe workplace, and planning their office ramp-up. This is demonstrated by a 23% uptick in employees working from our properties in July compared to June, and this number is expected to further increase in the coming months, with many occupiers indicating intent to return to office in strength by end of this year. We continue to actively support our occupiers in their efforts. Next, an update on our leasing. During Q1, we achieved 100% of the scheduled rent increases on 32 leases covering 2.2 million square feet with aggregate rent escalations of 13%. We are on track for the additional 14% rent escalations due on 5.5 million square feet across 57 leases in the balance of FY22. We achieved 545,000 square feet total lease up across 9 deals at 13% leasing spread. This comprised 161,000 square feet new leases at 17% releasing spread and 384,000 square feet renewals at 10% renewal spread. All the new leases were expansion by our existing occupiers to cater to their business needs. Our portfolio occupancy remained stable at 89% in Q1, in line with the previous quarter. On lease expiry, you may recollect that we guided to 1.9 million square feet expiries for FY22 during our previous call. Of this, 0.5 million square feet were likely renewals and 1.4 square feet were likely exits. We remain on track with that guidance. Of the 1.4 million square feet likely exits in FY22, we saw 0.2 million square feet exits in Q1. The balance 1.2 million square feet remain as likely exits with a mark-to-market potential of over 70%. While there will be an interim void period due to this churn, we view expiry of such legacy leases as an opportunity to bring rents to market, thereby delivering on our embedded growth potential. The second wave disrupted the office market recovery underway in early 2021. It impacted site visits and timing of deal closures. While hiring and business growth for many of our occupiers is very strong, they continue to defer leasing decisions and are prioritizing employee vaccination. However, several RFPs continue to be active in the market, and we are having a number of positive conversations on future leasing. Office demand is likely to rebound in 2022 as vaccinations pick up pace, business sentiments improve, and as occupiers ramp up their return to office plans and firm up their space strategies. Moving to our development program, we minimized down across a 5.7 million square feet construction by applying our learnings from the first wave of COVID. Post reopening, activity and labor at site are back to full strength. That said, we anticipate that the disruption associated with the second wave has had a timing impact on our project delivery by 1 quarter. The delivery of 1.1 million square feet built to suit to JP Morgan is a near-term priority, and we are targeting handover by year-end. This campus is a great addition to our Embassy Tech Village asset. The balance 4.6 million square feet ongoing development is due for delivery over the next 2 to 3 years. This positions us well to benefit from the ongoing consolidation of supply and expected demand rebound. Our on-campus development program is a significant growth avenue for us and helps to meet occupier growth needs. Given our ownership of all land for development and that our capex debt costs are amongst the lowest, we believe that the development yields will be attractive and will enhance both NOI and unit holder value in coming years. Moving to our total business ecosystem initiatives, we continue to reinvest in our properties, whether it is the convention center and skywalks at Embassy Manyata, the Central Garden and F&B at Embassy Tech Village, or the overall asset repositioning of Embassy Quadron. We continue to enhance our park connectivity, infrastructure, and amenities. At our Embassy Manyata property, the flyover construction at the park entrance is on schedule for delivery in Q2. Similar initiatives include metro connectivity for Embassy Tech Village in Quadron and the under development Hilton hotels at Embassy Manyata and Tech Village. All of these complement our office offerings and create unmatched value proposition for our occupiers. We are progressing well with our ESG roadmap comprising the 3 pillars of responsible business, resilient planet, and revitalized communities. Our 100 megawatt solar plant in Karnataka and our occupier corporate connect program in areas of health, education, and public infrastructure are 2 of many initiatives for a sustainable tomorrow. Several other initiatives are underway, and we would invite you to review the recently issued annual sustainability report for FY21 on our website to understand in detail the initiatives and disclosures under the ESG program. Our infrastructure projects create long-term value for our unit holders and fortify our properties for the next phase of growth. Along with our ESG initiatives, we are able to offer complete business ecosystem to our occupiers, a key differentiator to attract and retain talent. Finally, looking beyond the pandemic, the tech industry, domestically and globally, continues to report strong earnings, record hiring, and business pipeline given the technological transformation of businesses across all sectors. Recent earnings reports underscore these trends, with annual hiring increasing by as much as 80 to 100% from pre-pandemic levels. Concerns around attrition have also been highlighted in recent results. Therefore, attracting and retaining Indian tech talent has assumed increased significance for these global businesses. We believe that a high-quality, complete business ecosystem product has even more relevance and appeal in this new technologically dominated global business environment, which will continue to drive demand in the India office sector. We are very well positioned for the next phase and beyond. Over to Arvind now for the financial updates.
Thanks, Vikas. Good evening, everybody. Let me start with the financial highlights for first quarter of FY22. Net operating income grew by 36% year over year to rupees 6,213 million, with operating margins at 84%. Distributions for Q1 stood at rupees 5,346 million, or rupees 5.64 per unit, with 80% of distributions tax-free for unit holders. Raised rupees 12 billion debt at an attractive 7.4% interest rate and refinanced rupees 5.2 billion with an 80 basis points interest savings, and maintained our fortress balance sheet with liquidity of rupees 15 billion and low leverage of 23%. First, let me take you through our Q1 financial performance. Revenue from operations grew by 43% in Q1 to rupees 7,376 million, reflecting rent escalations on 4.6 million square feet, revenue accretion due to additional 6.1 million square feet completed area of ETV acquired in December 2020, and revenue from Embassy Manyata and Tech Zone CAM acquisition in October 2020. The impact of these positives were partially offset due to occupier exits. Net operating income grew by 36% in Q1 to rupees 6,213 million, mainly due to increase in our revenue from operations, as mentioned above. This increase was partially offset by increase in costs due to acquisition of CAM operations of Embassy Manyata, Tech Zone, and ETV in the previous year. EBITDA for Q1 grew by 33% to rupees 6,008 million, in line with increase in our NOI. Net distributable cash flow for Q1 grew by 19% to rupees 5,315 million. Earlier today, the Board of Directors declared distribution per unit of rupees 5.64, representing a 100% payout ratio. 80% of our Q1 distributions are tax-free to our unit holders, reflecting the benefits of the fourth quarter FY2021 restructuring of Embassy Manyata entity. Moving now to our balance sheet and our debt strategy. Our balance sheet continues to be conservative with 15 billion of liquidity, low leverage of 23%, and a AAA credit rating as an issuer. Additionally, a pro forma debt headroom of rupees 121 billion provides us flexibility to capitalize on growth opportunities. During Q1, we raised rupees 12 billion SPV level debt at a blended 7.4% interest rate, comprising rupees 6.5 billion rent amortizing debt at attractive 7.1% and rupees 5.5 billion capex debt at 7.7%, one of the lowest in the industry. Of this, rupees 5.2 billion was used to refinance existing debt at 80 basis points interest cost savings, and the balance will be utilized to fund our ongoing on-campus development. We continue to focus on reducing our overall debt costs, and at the end of Q1, our rupees 109 billion gross debt stands at 7.7% interest cost compared to 9.6% just a year ago. Given our ability to attract debt capital at competitive rates and the continuing flight to quality borrowers, we are evaluating early repayment of our rupees 36.5 billion listed bond issued in May 2019, carrying 9.3% interest rate. While this bond is due in June 2022, we have a call option for early redemption in November 2021. On a pro forma basis, a 200 basis points refinancing spread brings down our consolidated REIT debt cost significantly to around 7% compared to 7.7% currently. Subject to market conditions prevailing at that time, we will explore refinancing the entire outstanding of rupees 45 billion through a coupon-bearing debt. We believe this is an opportune time given the fact that debt markets continue to be positive for quality borrowers, and the recent approval to insurers to invest in REIT debt enhances access to deeper pools of capital. To summarize our overall debt strategy, our plan is to build leverage selectively, finance development through SPV level capex debt, and finance acquisitions through optimal debt equity mix. Further, based on investor feedback, including our top institutional investors, as well as to enable simpler understanding of the yield and growth components of a total return story by the growing retail investor segment, we are now targeting to consolidate all of REIT's debt to coupon-bearing instruments. Lastly, I'll update on the outlook for full year FY22. During a previous call, given the uncertainty around second wave, we had deferred guidance and instead provided an overall framework and key building blocks of our business projections. Given that we are witnessing a steady decline in cases, accompanied by gradual relaxation of restrictions and opening of businesses, we are now providing guidance which is based on the premise that we will not see increased caseloads or lockdowns for the balance of the year. Our estimates are based on the following assumptions. Firstly, we will benefit from the transformational acquisition of ETV completed in December 2020. With its stable 98% occupancy, robust collections, and 1.1 billion square feet delivery pipeline, we expect full year impact of ETV acquisition to reflect in both NOI and distributions for FY 2022. Further, we expect our NOI to reflect the positive impact of Embassy Manyata and TechZone CAM operations acquired in October 2020, and our overall NOI margins to be around 83%, reflecting change in segment mix given the acquisition of CAM operations. We had, at the time of acquisition, laid out pro forma accretion numbers for both ETV and CAM operations, and as of now, we expect to meet or even exceed our underwriting. Second, we will benefit from the full year impact of successful lease escalations on 8.4 million square feet in the previous year at an average 13% rent increase. We are also confident that we will achieve and collect rent escalations on additional 7.7 million square feet due in the current year at an average 14% rent increase. Coming to impact of exits, we expect our numbers to reflect 1.5 million square feet exits, which we reported in the previous year at an average rupees 63 per square feet in place rent. Additionally, we factored 1.4 million square feet of exits in FY 2022 at an average 50 per square feet in place rent, with a mark-to-market potential of over 70%. Next, our guidance assumes a total lease-up of 0.9 million sq ft, comprising 0.5 million sq ft of renewals and 0.4 million sq ft of new lease deals. On new lease deals, we remain optimistic of demand recovery starting next year, given the technology growth megatrend. Our two operating hotels totaling 477 keys are expected to see muted demand recovery for current year, given dependency on business travel resuming. We have factored a cash burn of rupees 340 million for this year, in line with previous year. And finally, coming to our refinancing plans and the impact on our FY22 distributions. Earlier during today's call, I have laid out a debt strategy around our 36.5 billion rupees listed bond issued in May 2019. Our guidance assumes that we will exercise the call option to repay this bond in November 2021, and we propose to refinance the total outstanding of rupees 45 billion through a new coupon-bearing debt. Factoring the above assumptions, for the full year FY22, we expect NOI to be in the range of rupees 22,871 million to rupees 24,530 million, with midpoint of rupees 23,700 million, up 17% year over year, and distributions to be in the range of rupees 19,667 million to rupees 21,093 million, with midpoint of rupees 20,380 million, up 11% year over year. Finally, we expect DPU to be in the range of rupees 20.75 per unit to rupees 22.25 per unit, with a midpoint of rupees 21.5 per unit, in line with our FY21 DPU. Do note that our guidance is subject to the evolving nature of the pandemic, including a possibility of a third wave. Despite the second lockdown in India for most of first quarter FY22, Embassy REIT remains in great financial shape, with resilient distributions and ability to pursue growth through organic and inorganic opportunities in the coming years. In the near term, we continue to remain focused on delivering on our NOI and quarterly distributions, maintaining our balance sheet discipline, and continually optimizing our debt cost. Over to Mike for his concluding remarks.
Thank you, Arvind. In summary, FY22 is off to an encouraging start. Though pandemic-related uncertainties still remain, we are optimistic of the opportunities ahead and committed to achieve our goals for this year and subsequent years. The economic outlook is certainly looking more encouraging. We are very positive about the global technology trends, as these will further provide significant new growth impetus for our business. Finally, I would like to thank all our employees, frontline workers, business partners, and our stakeholders for navigating this challenging time together, and we are grateful for their continued cooperation and support. Let's now drill into any details in Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Dayal from Bank of America. Please go ahead. Mr. Kunal Dayal, your line is in talk mode. Kindly go ahead with your question, please. If you have unmuted your line, kindly unmute yourself and go ahead with your question.
Okay, sorry, I was on mute. You should be able to hear me now.
Yes.
Great. So a couple of questions from my side. The first one is, it seems like that there have been no out-of-turn exits that have transpired this quarter. So is it fair to assume that the thought process of existing occupiers is now more constructive on the balance versus a quarter back? And then the second one is, as we think of return to office by Q4 of this year, is it still largely contingent on what happens around wave 3? Or given the vaccination levels, the timelines are more immune to the environment? Thanks.
So, Kunal, just your first question, do we see things as being more constructive around the conversations on leasing? And I think that's an unequivocal, absolutely we do. It's remarkable how quickly things have turned around from a very positive situation in February and then a 180-degree turn with the second wave. And now today we're seeing existing occupiers talking to us about potential expansion. We're seeing occupiers who perhaps 6 months ago were talking about surrendering small amounts of space, now coming back and saying that they would retain and perhaps even expand. So certainly we're seeing more constructive, positive, expansionary types of conversations. Those tend to be with our existing tenants. I think until people get their employees back at scale, which we think is going to be end of this year, the final quarter of this year, employees back, that is when we believe we'll see some real traction on fresh leasing from new occupiers as well as existing. And your question about is it contingent on any other eventuality, particularly potentially third wave, that is a contingency for everybody, but we're getting very encouraging sentiments from occupiers, great take-up of vaccination. Our occupiers have rolled out over 110,000 vaccinations, I think reported by 130-odd companies for us. We've done 10,000 vaccinations of our own frontline staff. I think there's a very positive sentiment about back to work in the final quarter.
For that, thanks, Mike. Maybe if I can slip in one question for Arvind. Arvind, on refinancing of zero coupon bonds, I think your earlier philosophy was that it could be a mix of coupon bearing and maybe just further zero coupon bonds as well. So just if you could walk us through, the shift in thought process as to, all of it being coupon bearing now. Thanks.
Thanks, Kunal. At the outset, Kunal, I think our philosophy of having the zero coupon bonds was to match the value of under construction properties, which comes from our principle of matching cash inflows from our properties as and when completed to cash outflows towards funding such properties. As of today, only about 20% of the under construction properties at the time of our IPO have been converted into completed and cash generating assets. Having said that, we have taken note of the feedback which has been provided to us by various stakeholders, including large institutional investors, around our philosophy. As I also mentioned in my remarks, we just wanted to enable a simpler understanding of our yield and growth story to the growing retail segment. And considering all of this, we have decided to consolidate our entire debt book into a coupon-bearing instrument.
Okay, got it.
Thank you. The next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Hi, a few questions from my side. So first is, Arvind, on this NOI guidance, 24 billion and the DPU of this 21.5. So I just want to understand, once you refinance this this bond, in Q4, because I'm presuming you kind of sustain this number for 2 quarters. So I just want to understand what happens in Q4. You see a big downward shift in DPU because of this coupon bearing debt. So that's the first one. I'll take the other ones later. And the NOI also, if you can just highlight, because your first quarter NOI is 6.2 odd, and your guidance midpoint is about 24. So basically, you're assuming that this Q1 NOI trend doesn't sustain for the full year. So I just want to understand, where do we land up on Q4 basis the guidance you have given?
Yes, Saurabh. So first on the DPU, talking about the assumption on refinancing on zero coupon, what we have assumed in our guidance is that we will be refinancing it into a coupon-bearing debt sometime mid of October, because this is due to be paid on November 3rd. So it has an impact in our Q3. It will have an impact on our Q3 as well as Q4. we have factored all of that into the 21.5. If I were to give you the exact number which we have assumed in our guidance, this refinancing will have a 1.5 rupee per unit impact for our full year guidance. So that is on the DPU. Talking about NOI, Saurabh, basically the 17% NOI growth factors in, if I were to just kind of give a very broad breakup, it factors in the ETV, the acquisition accretion of close to around 21%, factors in the escalation positive of around 2%, but it also factors...
I understand. Yeah.
Yeah, so let me...
So, Arvind, if you could just, from Q1, if you can just reconcile this NOI, that will be great.
Yeah, so just to keep it short, the impact of the likely exits will be seen in Q3 and Q4, which is what we factored a total negative of around 6%. All of this plays into the total number of 23,700 million.
Okay, and just coming back to this DPU, is it fair that the impact will be about 1.2, 1.3 per unit in Q4? That would be a fair assumption? This is whatever you've given.
It will be a simple math. It's 1.5 rupees for the 5.5 months. You can compute that proportionately for 3 months out of 5.5 months.
Okay, fair. The second one is, on this, on this share pledge. So your annual report has both Embassy and Blackstone pledging 100% of their shares. So could you comment on, what's happening there?
Yeah, hi Saurabh, Mike here. Look, I think it's not for us to comment on sponsors' internal financing arrangements. I think if you look at the last couple of years, their shareholding demonstrates their commitment to the success of the REIT. They have reiterated that, like us, they understand the strength and resilience of the business, and we understand that they're fully committed, as they always have been.
Okay, fair. Okay, third is, Mike, what percentage of the workforce is in parks today? If you can, in July, basically, what percentage of workforce would be in your park, and what number was this in February? And just one last thing is, of this 1.4 million square feet, I'm assuming you are not assuming any releasing. So, yeah.
Yeah. So let me take the numbers in the park, and maybe I'll ask Vikash to take the second part. So just to put some context, how many people are in the park today? There's about first off, let me start with there's a very broad range. Some occupiers are at 25-30% in different places, and some of the more international tenants tend to be at a sub 5% level. So a very broad range. I think city by city it also varies. Today, I believe there's approximately 17,000 people working in the parks. That went down to a low point of about 8,000 at the nadir of the pandemic. And to give you a flavor of where that was back in Jan-Feb, it was up at 27,000. So we're seeing big swings, but we have seen a big increase in the number of people just in the last month. And your second question about releasing, I didn't quite get the full question.
Yeah, so Mike, so the question was, of this 1.4 which is expiring, the assumptions would, I'm guessing you don't have any visibility on releasing of this, so that's why it's being factored into the NOI guidance. Will that be a fair statement?
Hey Saurabh, hi, Vikash here. Let me take that.
Hey,
so Saurabh, again, of the 1.4 million square feet likely exit, we've already seen 0.2 million square feet in Q1, and against that we undertook backfill of about 161,000 square feet this quarter. So basically, as Arvind mentioned in his assumptions, we have assumed a total lease up for the full year of 400,000. So what that implies is, for the balance 1.2 million square feet likely exits for the rest of the year, we have factored in lease up or backfill of about 240,000 square feet.
Okay, understood. One last question, if I can, may. Of this JP Morgan lease, now it is Q4, and your acquisition had said till September there is rent support. So what happens for that 1 quarter?
Yeah, so sort of good question. So basically, the way the rental support and the rental guarantee was structured is, that we buy this property on as if it's a fully completed basis. So for FY22, we don't think there will be any impact given that it is supported by rental by rental support. However, any delays, contractually the way it's been, any delays which is on account of construction delays due to pandemic or due to any other force majeure, that could be to our account, as is the case for all of our other construction. So next year, if this gets delayed by, let's say, by 1 quarter, which is what we are estimating, that in FY22-23 would be to the REIT's account.
Okay, so any delay in F22 is not to your account. The sponsor continues to pay that.
That is correct. But, as I mentioned, we were targeting this September. Now it's moved to December. So that 1 quarter impact we will have in FY22-23.
Okay, I'll probably take this offline. Okay, thank you.
Thank you. The next question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you so much for the opportunity. So if I got it right, what you're essentially saying is that for new leasing perspective, since you've already renewed 0.4, you're expecting only 0.1 to be renewed for the balance 9 months? Is that how one should read it?
Sure, Puneet. And your next, the other question, please.
Yeah, the other one is on the debt side. So we are seeing a debt increase of almost 4.81 billion, while if I look at CapEx, it was about 2.94 billion. So where is the gap and what is resulting in the excess debt increase, net debt increase?
Sure. So why don't I take the first one, Puneet, and maybe I'll hand it over to Arvind for the second question on debt. So Puneet, just to break it down, we had indicated and guided to 1.9 million square feet expiry split between 1.4 likely exits and 0.5 million square feet renewals. We are on track with that guidance given last quarter. So on the renewals of the 0.5 million square feet that we indicated, successfully renewed 0.4 in Q1.
Yeah.
Likely renewals for the balance 3 quarters is 0.1 million square feet. So nothing changes from a previous guidance of a total renewal of 0.5 million square feet. The balance 1.2 million square feet will be likely exit, most of it coming in Q3 and Q4 of the financial year. Does that help?
Yes, sure. Thank you. And I just, since you're on leasing, if I look at the trend on re-leasing, it's certainly more on second generation leases. Is there something to read on that? Or should one consider first generation, second generation leasing as pretty much similar?
When you say second generation leasing, you mean, so we're assuming that it's end of lease and then a new lease, which has been a significant part of that 545,000 square feet that we've leased in the last quarter.
Yeah. So basically, the older ones are getting leased out or renewed. Is there something more to read into that from occupiers?
Well, I mean, the point to observe from that is that on those older leases, we often have a very strong potential mark to market. So we see good escalations from those types of renewals.
And maybe I want to add here, Puneet, is that obviously it's also a natural progression simply because some of these legacy leases, we replace them with new age occupiers doing more sophisticated and high-end kind of value creation works who have higher propensity to pay rent. So I think this is, we would call it business as usual and normal course to kind of churn some of those long tenure, 10, 15-year-old leases to backfill it with more new age occupiers.
Understood. Okay, thank you.
So Puneet, on the question on increase in net debt of 480 crores, if I were to just give a simple walk of that, about 100 crores of the increase is because of the accrual of interest on Series 1 debt. About 140 crores is because of the loans we've taken from bank for capex purposes. And about 240 crores is the opening surplus cash, which is used for capex as well as other payments. So that's the broad reason.
But loans for capex is anyways cash in also, right? So net debt change of 480 it should all be capex only, right? And maybe 100 crore accrual of interest which I missed out here.
Yeah, that's correct. It's all towards capex, towards the 100 crores of the Series 1 accrual, and a little bit of other. Just to give you an example, we will place certain amount of fixed deposits for some of the BGs and LCs which we use for capex. So it's a combination of these.
But that also gets counted as cash only, right? So that shouldn't impact net debt again.
We don't consider those fixed deposits which are lien marked as cash.
Okay, got it. Understood. That's all from my side. Thank you.
Thank you. The next question is from the line of Adidev from ICICI Securities. Please go ahead.
Yeah. Hello. Good evening, everyone. Thanks for the opportunity. Just a question for Arvind. Again, on this working capital adjustment is almost 70 crores for this quarter. So just a housekeeping question. What is the nature of this adjustment?
Sure, it is. Hi. So broad breakup of the 69 crores. Some of this we had spoken in the previous calls, including the acquisition as well. Approximately 29 crores is coming from the rental support payments towards the JP Morgan building. Approximately 15 crores is because of this fit-out rental cash flows, which are treated as finance lease and not operating lease. And the balance is towards normal working capital movements, including movement in other current assets and current liabilities. So that's the broad split of the 69 crores of the year.
So just to follow up, so this trend should continue, this working capital, this accretion of cash, the remainder of the year, or will it smoothen out for the rest of the year?
Yeah, Adidev. I think broadly this is the trend which is going to continue for the rest of the 3 quarters, and the guidance also assumes similar numbers.
Okay. Second question is for all our under construction assets, can you give the cumulative number? What is the pending capex and the next couple of years or next 2-3 years, the annual budgeted spends, a broad number?
See, Aditya, hi, Vikas here. So why don't I take that? I'll guide you to page number 19 of our supplemental data book, but why don't I take you through that? Basically, we have laid down here for all our under construction projects, including infrastructure and upgrade projects, the capex outlay, the pending cash to be spent, split by all the projects. So basically, on the numbers, we are looking at spending about 2,663 crores over the next 3 years across the base build projects and the infrastructure projects. And there's a detailed breakup of that. Roughly, it was 3,000 crores last quarter, and we roughly, let's say, spent 300 crores during the quarter on construction.
Okay, fine. And just one last question. We have heard a lot of talk about the de-densification of office spaces because of the pandemic. So now in your discussions with your existing office occupiers as they bring people back to office, are you seeing, do you expect the leased area to go up on account of that? If you could just throw some light on that. Thank you.
Yeah, I think, the de-densification topic has kind of got bundled into the overall back to office, higher quality product. I think what's clear is that the type of occupier that we have in our portfolio is going to be looking for a higher quality product that may include less density, but it will also include specific requirements around energy efficiency and ESG requirements, safety and security, wellness for the staff. But broadly, some of those companies that are in our portfolio have had a very low density in the past in any event. It's really the ITES type of companies that had moved to the high density spaces. We would anticipate that there will be a move to a less dense, more collaborative environment. And again, that's going to be good for us because our type of product, not just within the building, within the four walls, but also the overall amenities of our business parks, is what the best occupiers are going to be looking for over the coming years.
Okay, and just last question, if I just squeeze it in. Are you again seeing fresh RFPs being floated in the market again from July, or is it just the ones which in Jan or Feb, which are again being revived?
Yeah, we are seeing fresh RFPs across the country. I think we've got a list of 26 million square feet of RFPs. We've actually scaled that back to something which is A, applicable to our markets, and B, we've written out a couple of the really large numbers that skew the overall numbers. And still, in our markets, we have visibility to about 9 million square feet of RFPs. And yes, some of those are new.
Okay. Okay. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Karan Khanna from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my first question is on the upcoming supply. So on your thoughts on the upcoming supply over the next 2 years. Your last quarter's presentation suggests nearly 37 million square feet of the upcoming supply is unrealistic, which is now reduced to 32 million square feet. With encouraging signs on the demand side, do you see further risk to the unrealistic supply estimates, and resultantly, how should one think about the impact on your lease expiries, fresh lease-ups, and the mark-to-market potential because of this?
Yeah, so I mean, our view on upcoming supply actually just gets reinforced every quarter. We've been saying the same thing for a year now, and it's turning out, like many of the things we've been saying, to be the case. We believe that supply over the coming 2 years is down 25%. We've had that reconfirmed from a number of different sources. That combined with what is clearly going to be a very significant uptick in demand, given the hiring figures being up so significantly, we think we're going to be in a very strong position in 2022. Does that address? I think there was some detail that I missed. I couldn't quite understand.
Yeah, Karan, why don't I add to what Mike said? Karan, our view is, and this is based on not only conversations, but what we are seeing on the ground, and pretty much we track line by line all the projects which are announced or which are under construction. If any project is already not under construction today, it is not likely to come up in the next 3 years. And on the basis of that, and the dislocation which we see in the availability of financing for some of the grade A minus and grade B projects, we really think supply is going to consolidate to very few institutionally owned landlords or developers with strong balance sheets. So we think this will start playing out. While there's a lot of talk about supply, we think actually the situation on the ground is to the converse, and a lot of the supply will simply get deferred. And there are some interesting anecdotes which are coming from the ground where in some cases the developers are contemplating or have already converted a potential announced supply which is coming in this figure that you mentioned to, let's say, a residential project also. So I think we'll see, we'll have to wait till it pans out, but we think supply is already declined versus what was announced, and it is going to continue to consolidate to very few landlords, simply because office business is a longer gestation business, and the capital requirements come into play.
Sure. And talking about the demand side, Vikas, we've seen data center emerging as an asset class, where one of the other REITs, the listed REITs, has also recently closed a long-dated agreement with one of leading data centers. So in that context, this being a fairly mature asset class globally, and given your experience, can you help us with your thoughts with respect to the opportunity with respect to this segment, and if you're seeing any RFPs from this asset class in your micro market?
Yeah, hey, Karan, it's Ritik. Let me take that. I think to just directly answer your question, do we get asked a lot about data centers? We do. But I think we've got to be a little pragmatic in the way we approach it. I think first and foremost, our bread and butter is being an office REIT, catering to the tenant base that we have for all the reasons that we've repeatedly outlined about why they're in India, right? I mean, the Indian talent pool is effectively and has been the biggest REITable story of our times, and that's the reason over the last 3 years you've seen 3 office REITs come to market. Now, clearly, given the global sort of technology mega trends that are taking place and sort of the pull towards sort of data analysis, data storage, and the preponderance of crowd of data centers worldwide, there's clearly been a focus in seeing how that can sort of be replicated in India. But I think it's an opportunistic view, but really depends on the scale. Data centers tend to be incredibly capital intensive. They definitely cost a lot more to put together than office. And I think it's really a question of the markets that you want to be that are most conducive to actually having data centers. For example, I think Bombay, given that it's a coastal market, or a market like Chennai, again, markets that either have access, coastal markets or good power are more conducive to setting up data centers. I think if you're looking at cities like whether it's Pune or Bangalore, I think it's really sort of more of an opportunistic sort of data center proposition that would make sense. As of this point in time, it's clearly given sort of the expenses involved, given the sort of high capital intensive nature of it, and given how we are actually deploying capital and thinking about growth in the office market, we think that at this point in time it's too complex, there's too many technicalities that involve our full and undivided attention. So we'll continue to analyze the market. I think we do, on top of sort of a lot of the intelligence that's there, we can clearly see some of the trends, and if we have something to report, we will.
Sure. Thanks, Ritik. And just one last question, if I may. With ETV in your portfolio now, what kind of a quarterly rental run rate can one expect, which will be possible once, say, the business normalizes, say, at 95% portfolio level occupancy? And further, assuming there is no threat of a third wave, etc., by when do you expect this could be possible, and what kind of distribution would be realistic at that point?
Yeah, Karan. So probably in terms of future, as Mike and Vikas mentioned, we are pretty positive on the demand returning later half of 22, considering all the technology and the GCC demand which is likely to come. But having said that, in terms of projecting or forecasting when we are going to reach 95% or whatever is the stable occupancy, we would want to stay away from that. And as time passes, we will keep giving you guidance on the more near-term numbers. But on an overall basis, I think we are pretty optimistic and bullish on the levers of growth what we have.
Great, sure. Thanks and all the best.
Thank you. We take the last question from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi. Good evening. Just on an earlier question on the distributions. So, Arvind, like even if we take the higher end of the distribution estimate of 22.25 DPU, and even if we adjust the 1.5 rupee impact on account of the refinancing, we're looking at almost 22.5 billion of total distributions. And if I adjust the Tech Village impact in this and try to do a like-to-like comparison versus last year, is it fair to assume that there could be a decline in the distribution excluding Tech Village? Is that understanding correct?
If I can simply explain this in terms of same store, as we've reported in Q1, the same store NOI is down 3%, and the same store number for the full year in terms of NOI is expected to be down 5%. And in terms of distributions, when you factor in the impact of the Series 1 refinancing and the 1.5 rupees which I spoke about, on a same store basis, the distributions are around 12 to 13% lower as compared to last year, and this has got offset by the accretion which we are estimating or projecting from the ETV as well as the CAM acquisition.
Okay, but that should be accretive, I thought, right? In terms of absolute distribution.
Yeah, so ETV is accretive both in terms of absolute as well as percentage wise. Taken together is our DPU number is flat. So there is a decline in the same-store distribution offset by accretion in ETV.
And that decline is 12% in the same-store distribution, right?
Yeah. So NOI is around 5%. When I factor in the impact of Series 1, the 1.5 rupees I spoke about, together with that, it's 12%. But just from a business perspective, the same store is 5% down.
Fair enough. That's quite clear now. Secondly, on the renewal side, right, the 1.4 million square feet expiries that we are looking at, a large part of that, almost 1 million square feet, is actually in Manyata, where the MTM increase that we are targeting is almost like 120% or. Firstly, just wanted to understand, have we renewed any leases at these kind of MTM increases in Manyata? Especially like last year, we have seen some releasing in Manyata. Have we done that at these rates?
Yeah. So, Kunal, why don't I take that? So the answer to that is definitely a yes. Let me give you an example. Some of the leases that come up in Manyata, which kind of reflects in the MTM opportunity we spoke about of over 80% on the 1.2 million square feet. I'm referring to slide number 28 of our earnings presentation. Those are realistic. The in-place rents today, to give you a flavor, are about rupees 32, 33 rupees, right? Whereas, in the lowest cost market in India today, let's say a Noida or a Pune, the passing rent or the market rents would be 50, 55 bucks. So, yes, these are achievable. In Manyata, in fact, pre-pandemic, we've done deals, crossing 105, 107 rupees, and we did report that in Q3 and Q4 of the first year. The rents that have been assumed here for the mark-to-market of 83% are the CBRE estimate of rents, and for Manyata, if my memory is correct, they have assumed a 93 rupees rent. In fact, the latest lease that we have presented in slide number 26, which is the new lease that we have done in Manyata, the two new leases, those actually, in the middle of the second wave, those have also been in excess of the CBRE guided market rent. So we think those are achievable. There may be a timing gap of a quarter, 2 quarters or so, depending upon the rebound, but we think those are definitely achievable.
That's helpful, Vikas. Lastly, just want to understand how is the landscape for acquisitions. We talk about new supply being delayed, stalled, but what is the situation on existing rental yielding assets? Are you seeing any attractive opportunities for acquisitions in very assets, or have capital values come off from the pre-COVID levels?
Yeah, I think on acquisitions we do see opportunity. I think, but we continue to be very very selective on how we view them, and very very stringent on the way we evaluate acquisitions. And let me kind of put it into this perspective. In a perfect world, we want to buy assets that resemble the assets we own in our portfolio, right? They cater to the world's best companies. They're in the best micro markets, and in sort of the top 4 to 6 cities in India, from just from a strategic perspective, right? And they obviously have to be accretive to unit holders netting. I think those kinds of assets effectively are, given sort of where the market is, are quite hard to find, and we will continue to be extremely selective in the way we incorporate and evaluate these assets in the portfolio and how we actually finance them. Now, there are a lot of assets out there in the market that are one-off standalone assets. Quite frankly, I think we think it's a difficult proposition to sit here and say that you buy maybe 500,000 to 1 million square feet and think that that's going to be able to provide a significant boost to a 42 million square foot portfolio, because our focus is really to widen the moat against our competition with scale and with the kinds of sort of assets that we have in the portfolio, as as well as sort of some of the opportunities we get from our partner and sponsor network. We've executed on growth on a ROFO opportunity. We do have the opportunity to look at more of that. We have opportunity to look at over 20 million square feet from our partner network as well. So there is clearly, there is supply out there. I think the expectations around value from one-off owners from certain parties certainly hasn't abated. I think the REIT is viewed as being strong credit, a strong currency, and some clearly it stands the test of time, both sort of from a resilience perspective and the potential for future growth. But that being said, we're obviously in no rush. We'll continue to evaluate the market and execute as we go along. You have to remember, we bought growth in a very volatile market and executed and continue to execute on that to the best in a very meaningful manner and in a very good manner. So I think fundamentally we'll be on the lookout, and we'll make sure that we update you as and when we see opportunities and execute on them.
Thanks, Satya. Thanks so much, and all the best.
Thank you.
Thank you. I would now like to hand the conference over to Mr. Mike Holland, CEO at Embassy Office Parks REIT, for closing comments. Over to you, sir.
Thank you very much. And to each one of you, thank you very much for joining today's call. I hope that we've been able to communicate to you two things. One, the strength and resilience of the business, so looking back, but also, secondly, our positivity about the midterm, given the very conducive supply and demand prognosis that we've set out. We genuinely appreciate all of your interest in the REIT and for the time today. Many of the data points that we spoke to are covered on our website, but we're always happy to engage further if there's any additional clarification required. So with that, we say thank you and good evening.
Thank you. Ladies and gentlemen, on behalf of Embassy Office Parks REIT, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.